Gambling just got a new twist, and it's not necessarily the kind that you find at a roulette table. The Big Beautiful Bill is capping your ability to write off 100% of your losses, and that could change how professionals and frequent bettors play the game. Today, we're breaking down what the 90% cap really means, who it hits the hardest, and why your record keeping just became your biggest winning strategy.
Welcome back to Full Throttle Finance, a financial literacy podcast where we take complex financial topics and break them down into fun, relatable content. My name is Felicia, and I am your CEO here at Clean Bee Consulting.
And I'm Allie, co-host and senior bookkeeper here. Whether you're running a race program or just getting your business off the ground, we're here to help you make small shifts that drive better financial performance. Last week, we walked you through a side-by-side breakdown of how the no tax on tip and no tax on overtime deductions will actually look on paper. We pulled up real spreadsheets showing gross pay, how the deductions apply, and how these numbers are going to flow into your taxable income and tax owed. So if you've been wondering how these deductions change your year-end tax bill, not just the headlines, that episode showed the math in action. Let's talk about a quiet little hidden change tucked away in the HR 1 that might hit harder than most people realize, especially with the rise in online betting and legalized sports gambling. Section 70114 changes the way gambling losses are treated on your taxes.
Yeah, so to give perspective, previously and what is still in play for 2025, because this change within the Big Beautiful Bill does not actually start until the 2026 tax year, unlike no tax on tips and overtime, which starts in 2025. This wagering change and gambling change, that starts in 2026. So how it worked before is that if you won $5,000 on a bet and then you lost $5,000 somewhere else gambling and betting, you essentially would cancel out your tax liability, right? 5,000 in, 5,000 out. That nets to zero, and no taxes were owed through the end of this year. But starting in 2026, the IRS is changing that, and you're only going to be able to deduct up to 90% of those losses against your wins. So how it's going to look moving forward is, let's say you win $10,000, but then you also lose $10,000 elsewhere down the road. Only 90% of that $10,000 loss is going to be deductible. So now you're only going to be able to deduct $9,000 of losses against those $10,000 that you earned, which means $1,000 of your income that you won is going to be taxable now. That concept is called phantom income, right? You're betting and you've won and you've earned $10,000, but then you've also bet and lost $10,000. You will technically have not earned anything in that. Now, starting in 2026, IRS is going to see that as you've made $1,000 and you owe us tax on $1,000, even though you didn't actually profit anything. That is what phantom income is. It represents. And it doesn't stop there either. The bill expands what counts as a gambling loss as well too. And that now includes any expenses that are tied to your gambling activities. So if you've deducted travel to, let's say, a poker tournament, or if you deduct your internet costs for online betting, or even coaching, if you're a professional gambler and you hire a professional to help you, that's all lumped into this 90% cap. And so remember, this only applies if you have gambling winnings to begin with. If you just bet $10,000 and lose $10,000 and you never win any $10,000, that doesn't change anything. None of that is deductible. That hasn't changed, right? So the bottom line is that if you break even, the IRS now gets a cut if you have won at any point during the year.
So I'm gonna break in here for a second, and maybe something that you can clear up for me is, let's say you win $5,000 and you lose more, so like you've bet more money than that $5,000. Are you still able to? I won $5,000, but I lost $7,000. Are you still only able to deduct 6,000?
So how it worked before is and how it works through 2025, right, is that you can only deduct the amount up to what you've earned, basically. So if you won 5,000 but you lost 7,000, you could only deduct to what you won, that 5,000, to bring you down to a net zero. You can't just gamble away and deduct and continue to ask the IRS for more money. They don't allow that. You can only deduct up to what you've earned and what you've made as a profit gambling through 2025. And how that's going to work under the new rule with the Big Beautiful Bill is that you're only going to be able to deduct 90% of the documented loss. And so it's still up to whatever you've earned. That doesn't change. So if you earned 5,000, but you lost 7,000, the 90% is still just over that 5,000, that what you earned. You can only offset yourself to zero. You can't dig further for a credit, essentially. And so what this means for both casual and professional gamblers alike is that your break even is no longer going to be tax neutral starting in 2026. It's one of the quieter revenue raisers in the Big Beautiful Bill. Like literally, I think it's maybe 4 or 5 very small paragraphs within the actual 800 plus page bill itself. But for millions of Americans who place legal bets every single year, it could potentially show up on your tax bill in an unexpected way starting in 2026 if you don't start learning about how this is going to impact you now.
Yeah, they really snuck that one in, didn't they?
Right.
So here's the thing. We're not here to tell you that this is an amazing change or that this is the end of the world for gamblers. Like most parts of the Big Beautiful Bill, there are two sides to this coin. So let's go ahead and start with the positives. So first, gambling and hospitality go hand in hand. Casinos, racetracks, even sports betting lounges are part of a much bigger hospitality ecosystem. Hotels, restaurants, entertainment, all that such. So here's reality. The no tax on tips and the no tax on overtime deductions are expensive for the government. They don't have a built-in funding source. So, but this change to wagering losses, it actually could be one way that they're helping to offset the debt that we'll rack up from those other deductions.
Yeah, I think that it's interesting, right? Like, this does kind of seem like a natural revenue stream that's tied directly to the same hospitality industry, who will have workers that take advantage of the no tax on tips and the no tax on overtime deductions. But there's definitely also negatives, like you said, right? Like, we're in an economy where people are already very cautious about spending right now, right? And if gamblers know that they're not able to deduct 100% of their losses anymore, it might make them take fewer risks, booking less tournaments, let's say. And in gambling, less risk often means less play, right?
Yeah.
Fewer visits to casinos, less time on your betting apps, fewer trips to the track, all of those things. And that has a trickle-down effect,
It sure
right?
does.
If they're visiting gambling establishments less, that means they're also spending less in the restaurants, in the bars, in the hotels, and in the travel industry as a whole, right? The surrounding businesses that also depend on that foot traffic will also suffer in tandem. And so this actually could hurt hospitality revenues at the same time. That same sector, that tip and overtime deductions are meant to help. So, like we said, it's not a clean good or bad. It's one of those changes where the benefits to the Federal Reserve could be real, right? We might not be racking up more debt like we initially thought with the no tax on overtime and the no tax on tips and not having like a built-in budget to fund those deductions. But the real long-term impact on the gaming, on the hospitality industries is still a really big question mark in my.
Yeah, and it's like you've always said to me, it's like there's always going to have to be a give and take. So, I mean, you look at the no tax on tips, no tax on overtime. There has to be a way to fund it.
And this is a
Anyways.
natural way that I think it could
It could.
fund that, but Yeah, who knows?
And now let's talk about who is actually going to feel this change the most, because a lot of casual gamblers, this might just be a blip on the radar. If you're the type of person who maybe buys a few scratch offs a month, places a bet or two on the Super Bowl, or plays the slots on a weekend trip to Vegas, this probably won't hit your wallet in a meaningful way. You're not racking up a big enough losses for the deduction cap to matter necessarily. When this really comes into play is for frequent gamblers, especially sport bettors, poker players, and anyone who treats gambling as a semi-professional side hustle. These are the folks who are going to have the big swings and the wins and the losses throughout the year. They're going to hit the hardest.
That's right. Before, they could deduct 100% of their losses against their wins, but now it's going to be capped at 90% of whatever they've won is what they'll be able to deduct up to for their losses. And, this is when record keeping is really going to play a big factor and become super handy, because under this new rule, sloppy tracking could cost you even more if you have not accurately captured all of your losses. Then you might be leaving some money on the table, right? The IRS already requires you to keep a detailed log of your gambling activity, like the day to play, the types of wagering. Is it slots? Is it betting? Is it horse racing? Is it poker, etc.? They want you to keep a log of locations where you gambled and the amount of each win and each loss that you have. And if you're playing online, you might be able to get statements from some of the betting platforms that showcases this information for you. But when it comes to in-person play, that's 100% on you to document. And the more receipts that you have, the better it's going to be for you when it comes time to do your taxes, right? And without solid records, you could lose the ability to deduct even the 90% that you are entitled to at this point. And so the bottom line is that this change isn't just about tax math, let's say. It's about how disciplined you are in tracking your play. And for frequent gamblers, that discipline is now the difference between minimizing your tax bill or leaving money on the table, essentially.
Exactly. That is a good place to wrap up today's breakdown of the wagering losses change in the Big Beautiful Bill. Whether you're a casual player or a professional bettor, the new 90% deduction cap means that your record keeping just became more important than ever. And if you're a pro in the gambling world, we can help you put the right systems and the right workflows in place, so you're tracking every win and loss ahead of time. No more scrambling in April. So if this episode got you thinking, hit the like, leave a comment, and subscribe. Never miss an update. We'll be tracking how this plays out and what it means for your bottom line. And we'd love to keep the conversation going with you. So thanks for tuning in. We'll see you next Friday.